Multifamily being the darling of real estate today in the preferred asset class, we've seen obviously a very large compression in cap rates and what we consider very, very aggressive cap rates. The fundamentals for multifamily are still strong and to a certain degree support those aggressive cap rates. But most of that support is really coming from interest rates. And what we have to recognize today and be very, very sensitive to and make sure it's on our radar screen, that cap rates today are being artificially depressed or suppressed, mainly from the Fed and the Treasury, who are trying to stimulate our economy coming out of the Great Recession. They continue to print at historic levels and continue to really suppress cap rates in hopes that that stimulus will bring back the economy to baseline employment and 3 to 4% GDP growth. That stimulus, which is artificially depressing interest rates, can't last forever. One, it's inflationary by nature, and two, eventually our ability to continue to print and add to the debt is unsustainable over the long term. So with that said, if interest rates go up, cap rates must as well, and so we have to be very, very sensitive to 2, 3, 5 years out as interest rates will rise, cap rates will follow, and we have to be sensitive to the impact that has on our exit pricing, impact that has on our baseline underwritings, and the overall impact that will have on our returns. And so moving forward, I would just caution everyone to keep an eye on your interest rates, lock in rates for the long period, and if you're going to exit over the short term, which is 2 to 5 years, make sure you've got some type of cap rate increases and interest rate increases in your baseline underwriting.